We would like to welcome you once again for joining us here today for this very special luncheon featuring the Africa Finance Corporation. Hopefully you are all enjoying your lunch and you're ready for the important message that our presenters have prepared for you today. Following the presentation, we'll allow some time for some questions and answers. And so without further ado, let me begin our program by introducing our first speaker. He studied economics at the University of Nigeria, where he won the prize of the Faculty of the Social Sciences for the best graduating master's degree student, and subsequently, yes, he's ready.
Well, once he said University of Nigeria, I then knew who he was about to talk about. And let me just say how delighted I am and join my voice in welcoming all of you to this particular event. For me personally, one is really speechless, because this particular event happens to be the very first public outing that the Africa Finance Corporation is having since the formal governance structures were put in place in terms of the board, the management, and some of the key staff took off. And therefore, it gives me, sometime early this year, January, February, sometime even early March, we moved around. We were in New York, we were in London, we were in some African capitals promoting the idea of the Africa Finance Corporation. And I think this luncheon, is simply to say it's alive at last. And I want to say, let me start by welcoming all of you, the honorable ministers here. You can see Ibn Chambers, the executive secretary of the ECOWAS, the former. Oh, sorry. Your Excellency, Mr. President, sir, you're welcome. I see many CEOs of regional institutions, the former executive director at the World Bank, the honorable ministers. I see honorable Minister of Finance, the Minister of National Planning, the distinguished senators. I must especially acknowledge that you have the chair of the Senate Committee on Banking and the chair of the House of Reps Committee on Banking, all seated here. Baroness Choka, it's really a pleasure to have you. Now, all the CEOs of various institutions, African and global, the movers and shakers of the world financial and business community. I want to say a big welcome to all of you, and to say that the Africa Finance Corporation, what I'm supposed to do, and I'm asked to just say so in very few minutes and leave the floor for the real thing to come. Mine is to simply welcome you and to say that the idea of the Africa Finance Corporation being a private sector-led African investment bank actually was motivated by the huge need in Africa, the huge developmental challenges in Africa, especially in the areas of infrastructure, and I will come to that in a second, especially in the areas of infrastructure, mining, financial services, telecommunication, industrialization generally. The need is huge. The financing needs happen also to be huge, but the available resources are very small. And as well as the fact that indeed bankable projects are also very few and far between. I participated before I joined government in a major project that led to the book entitled Can Africa Claim the 21st Century? And we said the answer to that happened to be yes, provided. And the major model in all of those, and several of the other thoughts that have come, is that if Africa is to claim the 21st century, it must be a development process that is led by the private sector. Currently, much of the landscape in terms of regional financing in Africa is dominated by multilateral institutions. They are doing very important work. The World Bank, the ADB, the IFC, and several others, Afrexim, and so on and so forth, and even sub-regional financial institutions. But relative to need, the need is simply humongous, and the available resources few. And therefore, we reason that the time has come, if we truly want a private sector-led development in Africa to take root, that development process, as a necessary accompaniment or complement to the set of financial institutions, must also be a private sector-led investment bank that will help the process of not only project origination, but also in helping to put together the requisite financing, especially for private sector-led projects. I think the numbers speak for themselves. Right? That's why I just left it there. There's some slides there in terms of trying to estimate the huge need in Africa, all over, especially infrastructure. But AFC, being a private sector-led initiative, has come to complement, not to substitute for, the existing ones. Because our thesis is that even if you have 10 more AFCs, 10 more IFCs, 10 more ADBs, and 10 more of the exposure of the World Bank in Africa, there will still not be enough relative to the huge needs of the continent. And therefore, AFC comes on stream to complement the existing set of institutions in the continent today. It started as a dream, a simple idea, but today it has taken form. It's taking form, and it is, I believe, that in the next few years, in the next couple of years, the Africa Finance Corporation will truly be the key driver of infrastructure financing, development financing, the area of industries, and the coterie of sectors which I think the CEO will elaborate upon in a few minutes. But a key idea is that it has come to complement the set of institutions and not to well, I don't want to say not to compete. In some areas there might be a little bit of competition, and I think we need a bit of it, isn't it? And I tell you just two little stories. I think in one of the sessions at the World Bank, I think somebody said that for one of the development institutions here, it takes an average of about 3 years to negotiate a project and 2 years to start disbursement. And they say it's concessional. Well, when you add the opportunity cost of all of those, of waiting for 5 years to start, drawing down on it, and even when that, with all the conditions I cited in a haphazard manner, the true cost of it might be even much more than you could, walk just across the road and talk to AFC and get it financed. So, so you're likely going to get a little bit of pressure coming from there. And then there is a little story, which we're told this. It sounded like a joke, about one of the institutions that holds sway in Africa participating in financing a particular project, and then AFC comes also to be part of the same project, and that institution now calls the promoters and says, listen, we don't want that other one to put in more money than, we don't want AFC to put in more money than we are putting. So whatever they put in, we are likely going to scale up our own too. Well, if AFC in this form is engendering new competition, and there is also a regional institution in Africa, which I understand has tried to scale up its involvement and engagement in the area of infrastructure financing. They're trying to reform their processes to ensure quicker discussions and disbursements, because I was told by one of them that in their board meetings now, hardly do they finish without somebody in one way or the other referencing the fact that, well, if you people are here, then the AFC might take up the field. And I say, if it is competition in this sense, then welcome to the world of the AFC. And I think Africa will be much better for it. The dream is for us to have additionality for Africa. If Africa stands a chance of claiming the 21st century, you are welcome to join the train of the AFC. At least there are options, there are alternatives, and this key strength in the area of asset origination. I want to acknowledge particularly the members of the board of directors of the AFC who are here, the CEO who will be speaking, and especially the Honorable Minister of Finance, Dr. Shamsuddin Usman, who happened to be, well, still today, he's still a member of the board, even though he's migrated to the other side as the Honorable Minister of Finance. That has to still, if he would, well, Honorable Minister, we'll have to talk about that. Whether you wear, how you wear the two caps. And so, Honorable Minister Dr. Usman is here, the Honorable Minister of Finance. We have Dr. Mrs. Ibru, who is the CEO of Oceanic Bank, I think one of the largest banks now in Africa, is here. And then, Augusta. That's the CEO of, I don't want to say First Bank, First Bank, which is, I want to advertise that you are, the Leadway Assurance. Yeah. Well, you're welcome, sir. It is Pan-African. So far, we've raised about $1.05 billion in capital. It has an authorized share capital of $2 billion. Well, if you still want to write the check, for the bit of it, we can negotiate and see in what terms you can come in. But the train has left the station. I want to say welcome, and may we then relax and listen to the real presentations. I think at this juncture, I just want to just squeeze on. These are the things I was asked to say, but I have left them, and you can get a copy later on, okay? Thank you very much. I welcome Ometorowa, the CEO, to now make a presentation.
What I would like to do is to basically give some definition of the thought process that has led us to this stage and our vision for the future, including the directions that we envisage to take the AFC. I think that one point is clear. Africa today is the least developed continent in the world by all of the matrices that we're looking at. That represents a significant challenge because 50 years after independence of the continent, we're still struggling with significant issues of development. Now, one of the things that is very crucial for us is that the AFC should not become another institution, because already in the spheres of development, there are 3 cycles of institutions: the international development finance institutions, the international private banks, and the local financial institutions. If 50 years after, we're still talking about the challenges of development, we have to think through as to what is it that AFC will bring to the table that would result in significant improvement and significant result. Because it's not sufficient to just have another institution that is designed to do exactly what everybody else is doing. And that's why we spent 8 weeks in a very intensive strategic exercise with McKinsey and Company, because we wanted to have that clarity that AFC can add value and deliver value, so that 50 years after, and hopefully probably 5 to 10 years after, the results of AFC can become much more practical for the environment. Why is there no development 50 years after? We think that there are probably 2 or 3 very critical issues that represent the pillars of this problem. We know there's development problems in Africa, but the challenge is, how do you convert these problems into bankable projects? Because it's not sufficient that all of these problems of infrastructure, of industrial capacity exist. Except these problems are converted to bankable projects, it's going to be very difficult to engage the private sector in assisting in the resolution. Now, if you want the private sector to be involved, the private sector has to go through the process of understanding that the project works, the project can achieve returns, the risk that exists in the project can be defeased, and there are structures that will make the investors comfortable. We are very clear in our mind that there's sufficient capital in the world that are looking for bankable projects, especially in a situation where, with Africa, it's very rare that you have in most of the sectors monopoly positions in the sectors we're talking about. In the rest of the world, you actually have situations of excess capacity. But in Africa, you actually have no capacity. So in most cases, when you're looking at projects, you're setting up the first project in an environment where already people pay international prices for very little capacity. So one of the focus that AFC will have is to basically originate and create bankable projects. The second focus is the issue of risk capital. It's much more difficult to actually have a bankable project and attract investors and lenders if the project sponsors don't have the capital required to ensure that the project is complete, both physically and financially, and to sustain the project. Now, it's obvious as well that most of the projects with the African sponsors, most African sponsors have limited capital. And that in itself tend to undermine the bankability of the project, because most of the lenders and the investors are not comfortable that the sponsors, in the event of cost overrun, in the event of delay, can come up with the resources, the equity resources, to make the project work and to complete the project. Now, finally, it's also obvious that the opportunities that exist in Africa are largely misunderstood. There's a lot of research about African private sector and African business, but most of the research flows from the macro research, the research of existing companies, but there's very little research about project development, about new projects, about new sectors. And this is an area that we want to focus on. Now, finally, we want to be in partnership with existing institutions, because it doesn't make sense that if we want to fire on all cylinders, there's already institutions that have been established for many years and have skill sets and resources. I think that our role should be really to push the envelope so that all of the institutions that currently exist and are targeted at developing Africa can work with AFC and can actually use the AFC model to make that incremental effort. And I think at the minimum, we'll consider this initiative a success if all of the three circles of institutions are galvanized and motivated by the AFC and by what AFC does to do much more, for the development of Africa. I talked about bankable projects. One of the things that we did was to basically focus on what are the key sectors that we have to prioritize. The challenge is that if you don't focus and prioritize, we could end up losing the concentration of where we can have the most critical development impact and the most critical return for the investors. We have selected 6 sectors: power, oil and gas, transportation, heavy industry, mining, and telecoms. These 6 sectors represent, in a sense, very critical examples of the shortages of capacity that exist today. For power, for example, a country like Nigeria with 140 million population has about 3,000 megawatts of power. That's the equivalent of 30 watts per person, which is half a light bulb. That demonstrates how critical, the shortage that currently exists in the power sector. And that is the same picture, thank you, in West Africa and in sub-Saharan Africa. The oil and gas sector is a critical sector as well. To sustain 2.5 million barrels per day production in Nigeria requires an investment of about $15 billion. Now, under current situation, the government is actually having to take from the Treasury probably $3 to $4 billion of cash call to co-invest with Shell and Chevron to sustain the production. Now, if you think about it, that's $3 to $4 billion of resources that should go to health and education that is actually going to the most bankable sector in the economy, because there's no reason why the oil sector should not be bankable, especially when you're talking about sustaining working investments. Transportation is also quite a critical challenge. We're all familiar about air safety in Africa. Most African airlines don't acquire new aircrafts. Most of them, the average age of the African airline aircrafts are probably 15 to 20 years old. That has serious implication for air safety. Similarly with the airports in terms of navigational aids, that also has serious implication in terms of safety. Sub-Saharan Africa has no deep sea port. Over the last 5 to 6 years, international freights have increased by about 1,000%. Now, the reality of what has happened is that if you don't have a deep sea port and each of the countries are basically, there's no transshipment, it makes it much more expensive for businesses to develop and to thrive. Now, the same thing with shipping. There's very little shipping capacity that represents African content. And the whole viability of shipping business is captive cargo. Now, if you think about it, there's significant captive cargo that African businesses and countries generate, but they've not been able to develop a shipping capacity, to match that. Heavy industry that cuts across cement, steel, petrochemical, fertilizer, aluminum. These are all industries that, given the natural resources that Africa has, in terms of natural gas, in terms of power, Africa should not be importing cement, for example. I mean, most of Africa imports cement. And what is cement? Cement is limestone and gas. Nigeria is one of the largest importers of cement in the world, with probably one of the highest cement prices in the world. Now, I think that one of the exciting examples of cement is it took a local Nigerian business to be able to create a capacity that has ensured that Nigeria's capacity, rather than being 3 million tons for the last 30 years, is now actually increasing to about 11 million tons. But the reality was that, quite frankly, as far as the existing providers of the 3 million ton capacity were concerned, they made more money from importing cement than manufacturing cement locally. So we actually have what really is a ridiculous situation where you have Cameroon, Nigeria, West Africa, Congo importing cement from Taiwan that effectively gets the energy from Africa, and the shipment is $100 per ton to import cement. So that demonstrates, again, where capacity is quite critical. Mining is even more challenging. I mean, over the last 6, 7 years, there's been a global boom in mining. But there's probably only one mining company that is owned by an African, Moana Kalapinga. Now, imagine all of that wealth that has been created from the massive increase in prices from copper to gold, and there's not one significant African capacity in mining. Finally, telecoms. There's clearly progress with telecoms, with the GSM businesses. But there's no progress in the backbone. There's a significant effort, for example, to create a $100 computer, for the continent and developing countries. But the challenge is that it still costs $150 per month to access internet. So quite frankly, except you invest in the backbone, there's very little value addition you can achieve. Now, I give most of these examples because in the presentations that are going to come through, what we've done as AFC is that we're not going to sit and wait for applications to come to us looking for financing. We have to be proactive. We have to basically look at these critical sectors and look at them because they are bankable in the context of you have a capacity that doesn't exist today. You have a market that people are paying international prices for. Of course, there are risks, but the risks as bankers, we are trained, the training of bankers is to understand risk, to mitigate risk, to structure risk. And that's where you make profits, you make gains, because you are able to manage risk. And I think that's the skill set that we want to bring to bear in development lending. I will give a summary of what our business model is. As I said, our mission is not to basically sit and wait for application. Our mission is to be proactive. Now, what that entails is that we basically want to seed capital projects, and we want to take responsibility for project financing it. Now, that clearly means that once we are drivers of these projects, we are able to get partners to work with us. We're not going to take stupid risk. We want to have a disciplined approach, and that's why we're starting with prioritization. We're focusing on sectors, industries that are bankable. It's so important because as a private sector initiative, this is what makes the difference, because we're very comfortable that private sector have the capacity to build projects, to complete projects, to sustain projects. And that's why it complements whatever effort the public sector has been undertaking to date. And it provides, the vision that we want to put on, want to push forward as a solution to develop Africa. I will not go into the details for the interest of time, but I would like to summarize this way. We already have raised $1 billion of capital. Now, based on the Tier 1 capital ratio of 10%, that gives us a capacity of about $10 billion of assets that we can impact in terms of development and in these sectors. But more crucially, we have an investment banking model where we want to be a catalyst. We don't want to just book loans. We want to be a catalyst. We want to originate projects and want to get partners to work with us. Because that $10 billion of asset capacity, if for every $100 project, we provide $20 and we get partners to come in for $80, you've actually now increased that capacity to $50 billion. But the crucial thing is that the more we originate projects, the more we give people confidence that the private sector projects work in Africa, the more we give investors confidence, we give lenders confidence. And it's that catalytic role that we want AFC to demonstrate so that we can have market confidence for investors to invest in Africa. I think on that note, I will actually now call on Acha Leke of McKinsey to give us some more color on the analytical process we undertook.
All right. Thanks, Austin. As McKinsey, we're actually very fortunate to work with Austin and his team to help put together the strategy and business plan for the AFC. What I wanted to do is just spend a bit of time, give you a sense for the depth of work and research that went into creating what we believe is actually a very robust strategy and very sound financials for the AFC. And Austin has talked a bit about sort of the high-level outcome of the work. So just to give you some sense of how we got there. The first piece of work we did was actually looking at which sectors should the AFC focus on. As Austin said, it was important to make sure that we don't, Africa has a lot of problems across multiple sectors. And the question we had is which one should AFC really play a role in? One axis, as you saw in the previous chart, was very much around how attractive is that sector. So everything about growth and how much money is needed in the sector, what kind of returns you can expect from the sector, who's playing. But another fundamental component for the AFC is actually what is the developmental impact of investments in that sector. So where we considered there were things around the economic impact, quite importantly, the multiplier effect from investing in that sector, the downstream effect from that, and how much employment you can create from actually investments in those sectors. That's what led us to the 6 sectors that Austin mentioned. As we said, those are not the only sectors that AFC should focus on, but our strong recommendation was that AFC, if you look back, about 80% of AFC's investments should be in those sectors that have a high attractiveness from a financial perspective, but also a very important developmental impact. The second piece of work we did is actually spent a lot of time with a number of you in the room, a number of the institutions represented here, and a number of investors across Africa, just understanding what the issues are to really get a sense for where AFC should play in the space. Again, there's a role for the local banks, there's a role that the international banks are playing, the development financial institutions are playing. So what really is the unique role for the AFC? And no surprise, right? Everybody talked about still a strong need for, a lot of equity, quite a bit complemented with debt. Look at some of the quotes that we got, again, to the governor's point, a quote that we were told, if AFC invests, others will follow. And as you can see, that's happening right now. So spend a lot of time just talking to people who would potentially receive these funds and players in the space to understand what the unique value proposition should be for AFC. Thirdly, we actually spent, this is a very extensive, actually bottom-up piece of work to really try to size the investments needed in each of these sectors across sub-Saharan Africa. I personally think this is still on the low end. We found about 130 billion worth of projects over the next 5 years. And we went sector by sector, really looking at across different countries, what are the potential deals in the pipeline, which ones could AFC play a role in and how. And as you can see, about 24 billion in power. Again, that's one of the biggest investment needs. Across Africa, we found about 130, call it 150 gigawatts of power. That's additional generation capacity needed. Oil and gas, both to fund, like us, the existing production, but also to help the national oil companies across multiple countries in financing some of their needs, transport infrastructure, heavy industry, mining, telecoms. So quite detailed piece of work backed up by a robust database of a pipeline of projects across each of these sectors that the AFC should consider. And this then led to a financial model for the AFC as well. And then finally, we said, okay, to deliver on this, we need to make sure that there's a pretty solid operating model in place for the AFC. So we spend a lot of time on this, talking first about the governance of the AFC, composition of the board members' responsibilities, different committees, and help Austin then put that in place. The organization structure, right? So what type of organization do we need in the short term and in the long term to deliver on this very aggressive aspiration? Thirdly, the business unit processes. I spend a lot of time thinking about what are the right world-class but quite lean processes to make sure that the AFC is not considered as another bureaucracy for people who are looking to partner with the AFC. So try to figure out exactly how do you maintain the integrity of the process, but how do you streamline it as much as possible to ensure quick decision-making. And that's in place now. And finally, as the AFC aspired to an investment-grade credit rating, what would it take for the AFC to get there? But more importantly, what type of processes and procedures need to be put in place now to make sure we get there down the road, right? So all of this said, we did over sort of an 8-week process. We'll continue to support the AFC going forward. Very proud about and fortunate and privileged actually to work with the AFC on this. I'm very excited for the AFC and for the continent as a whole. So I will stop here and invite Isaac Sam to come and talk a bit about the progress made to date across the different sectors. Thank you.
We've actually been in business only for about 10 weeks. Between April and the end of July, we were looking for an office space. We were looking for furniture, and we're identifying people who could come start the operation. At the beginning of August, when I first came in, there were 4 of us. But the chief executive, recognizing that yes, we were only 4, still insisted that we got to begin business, and we got to fire on all cylinders. So we started by identifying projects. We started by looking for projects that, if you will, were of low-hanging fruit, so we could take immediately and start working on them. Rather than me talking about what progress we've made, what we've done is invite 4 of the partners that we've been working with. Our approach has been come in, work with them, see where the gaps are and where we can make the most contribution. As Austin had mentioned earlier, sometimes risk capital is crucial in moving a project forward. What we've tended to do is provide money in the form of bridge financing so we can work with the local banks, give them some sense of comfort, and then take on the mandate to go look for the long-term capital, which will take out the bridge financing. As we speak now, we have 8 people. By the end of this year, we'll have 12. And by January, we hope we'll have 14. Most of the people who are not on board yet have accepted offers, but because we're looking for people with experience, it takes a little bit of effort for them to ease themselves out of their present jobs. I myself feel quite fortunate, after a quarter of a century at the World Bank, to be joining a team that is really starting something new. And believe me, some of the people that we have in AFC, sometimes I wonder where they get their energy from. We have about 20 projects in the pipeline. 4 of these are very actively being worked on. They cover power, they cover backbone communications, they cover strategic relationship with the established institutions that have the expertise and the capacity to move forward some of these things. And they cover the mining area. Rather than going through the list of projects, what I'd like to do is to invite each one of them to come and tell you about what we have been doing. But before I do that, I want to recognize one of our latest clients, We haven't even signed an MOU yet, but we're working with them, and that is GCAD of Ghana, working on an IPP in Tema. Mr. Fred Asamani, please stand up so they can recognize who you are. I would like at this point to invite Ms. Funke Opeke to come up here. Funke is someone driving a backbone communication. Earlier in the presentation, it was mentioned that it costs about $120 a month to be connected to the internet. That's because there's lack of capacity. Funke's vision, which we've bought into fully and working with her, is to lay a backbone cable from Portugal all the way across the Atlantic coast along the West African coast so we can expand the capacity. Today, the capacity that exists is capacity controlled by the government-owned telephone companies whose prices are so high that it's become a barrier for Africans to have access to the internet. With the project that she has, it would be available to the deregulated telephone companies of the continent so prices can come down and allow greater penetration of data on the continent. Ms. Opeke spent 20 years here in the United States, became an executive director of Verizon, then returned home, was chief technical officer for MTN, and then oversaw the privatization of Nitel. We're very proud to have her, and we love the idea that, incidentally, she's a woman entrepreneur.
According to the International Telecommunications Union, Africa has less than 0.2% of the total capacity in international communications on a global basis, yet we have 14% of the world's population. All of our countries, the majority of our schools, have less than 4% access to the internet across sub-Saharan Africa, and we worry about the quality of education and the higher institutions. Notwithstanding the lack of access, these institutions and countries are currently spending about $400 million annually for limited capacity solutions and inferior quality of service. So for this limited capacity that we have, we're spending disproportionate amounts to get low-speed communication services from the incumbent national telephone operators, as well as satellite communication companies. This is the problem or the need that Main Street Technologies has set out to address. What we're doing is developing plans to deploy a 10,000-kilometer cable system that will run from Portugal to Angola, with landing stations in major capitals in Africa, where we're able to harness the market from emergent telephone operators, as well as other service providers, internet service providers, fixed wireless access providers, and bring it onto this cable to develop the market. The system will provide up to 2.56 terabits per second in capacity. And to put that in context, that is more than 20 times what is currently available in the market. Our objectives are to do this estimated project cost. We've completed the initial commercial feasibility study for $350 million. With that price and our projections of entering the market at prices 50% lower than what the market price is today, and dropping that to 75% lower than current prices within a few years as we build up capacity on the cable, will still generate a very viable financial project with IRR of greater than 30%. We are delighted to be working with AFC as our equity partner. Our objective is to sign contractual agreements to deploy the cable during the first quarter of 2008, and to have the system ready for service in Nigeria in the second half of 2009, and across the continent in 2010, clearly in advance of the Africa World Cup. Thank you very much.
I would like now to invite our point person on the mining sector, Paulo Gomez. Paulo, a former executive director of the World Bank, educated in France and Harvard, has had an idea, and the idea is very simple. Africa has a lot of mining resources, and yet, as Austin pointed out, only one mining company. When Austin was speaking, I heard somebody mention Ashanti, but Ashanti is no longer an African-owned entity. It's been absorbed by Anglo-American. What we are trying to do is to partner with Paulo to begin to acquire mining assets, so for the first time, Africans can begin to own some of the assets that are on the continent. Paulo.
Thank you very much, Austin and Sam. Let me say here that this idea came out from a little bit of frustration. After spending years at the World Bank and being involved with very lucrative operations in mining, coming from the Chad-Cameroon pipeline to projects in Guinea, in iron ore, or copper project like the Tengue Fungurunde, which will be the best copper project in the world. Actually, I believe that when they start digging up the copper, they will spend years and years before they reach the bottom. And when I see the process of nations from India to China to others running to grab African resources, my question always has been, what's going to happen when we start growing ourselves, our economy? In the last 4 to 5 years, we have managed to grow at 5 to 6%. Let me tell you that I see the 10% growth happening in very few years because we have learned enormously from our mistake in the past, and the wave of reform that we have started in the 80s and 90s will start to pay off in the next 5 to 10 years. And where the copper, iron, steel from Africa will come from. I don't have time to show you the statistic, but we have done a very thorough analysis of numbers in terms of the reserves. There's not enough copper discovered now to meet the Chinese demand. By 2015, they will probably reach a GDP per capita close to $1,500 per year. And that goes along with, if you do a graph, with the consumption of copper and aluminum per capita. If they follow this path of growth and they reach the level of GDP per capita of Japan or Germany, we don't know where the copper will come from to meet the Chinese demand. So that doesn't mean that I'm extremely optimistic about the prices of those commodities, because there may be a risk also, a downfall on the prices, but there might be not enough of these commodities for our own economy. Now, that's the long term. In the short term, and I would like here to put on record, when I started moving around the continent to try to discuss with the head of state, you know, the thing when you leave the position of executive director with very pompous protocol, the risk is when you leave your office, nobody wants to return your call, and you end up being frustrated. I was very lucky. In every country I visited, I got enthusiastic support from head of state, and have enabled me to have access to some of the concessions. Obviously, you have to still work and look at the proven content of some of the concessions. From Cote d'Ivoire, in a country in crisis, where we had access to gold and diamond concession. From Congo, in diamond. From Angola, where people say it's very difficult, I understand it's not easy. But guess what? I'm coming from a Portuguese-speaking country, so it was easy to speak in Portuguese. And I had access to very good information on some of the commodity. This can become very quickly, ladies and gentlemen, a more than $1 billion company. Now, you have to invest you have to bring the best of this world, and this is what I really like with Austin, that I think in Oroco here is important to mention, how he has really behaved in making sure he gets the best companies to run some of the ideas that they have put in place. Because the issue is not only to say, well, do you have African capacity for diamond, for copper? If we don't, we're going to buy it and move forward. And this is, I think, what should be our objective. So quickly, Constellar Resources will continue to build a deep inventory of assets from Angola to Congo again to Liberia to Guinea. We own 45% of the world reserve in aluminum, bauxite, to Mauritania, in iron ore, diamond, and other commodities. There will be also a process of acquisition. We will go straight to the jugular when we can to buy minority position or majority position on some existing mining company. Because there have been also an exercise in the last 5 to 4 years of company coming and trying to grab some assets, and at the end of the day, they did not develop them. So we'll see how to build partnership or try to acquire some of the company. The cost that you see of $25 million is essentially operating cost for the company. And as I said, this is not the investment program itself. That would be much bigger. And as I said, we will not shy away from hiring the best Australian or the best Canadian or the best South African who could bring us the expertise to map out, again, some of the reserve that we have. And, you know, when I was looking at some information, even from South Africa to Mauritania, there's still a huge need in terms of research. We haven't discovered, I mean, even 50% of the reserve we have on several of the commodity. So I think we'll have access to this prime project. We will continue to build the asset, the pipeline of this asset in many countries. Austin have hired also some very competent people, and I would like to here to identify Kawa, who's from Cote d'Ivoire and has had experience on mining, went to Colorado School of Mining. So I will be open for more questions after the lunch or during the lunch for more clarification. Thank you.
Let me next call on the sponsors of a project that is very dear to our hearts. It is a power project, very uniquely designed. It's an IPP that has associated with it the distribution system. We are very proud of it, proud to be involved with them. The person who is going to tell you about it is Mrs. E.J. Ikoku. But before she comes on, I'd like to recognize Professor Bart Nagy, former professor of robotics at the University of Pittsburgh, Professor Bart Nagy. He is the chairman, CEO of the company called Geometric Group. And now may I call on EJ to come tell us about this project.
Thank you, Isaac. Good afternoon, ladies and gentlemen. I'm going to tell you a bit about our company and the project of focus, which is the Aba Independent Power Project. Geometric Power is a company that was set up to aggressively address the continent's power sector needs. Our second project is the Aba Independent Power Project. Now, this project is a very unique off-grid power solution that combines both generation and distribution in addressing Aba's needs in an island mode setup. The city of Aba, for those of you who do not know, is one of Nigeria's many industrial hubs. And what attracted us to Aba was its proximity to source of fuel, the diverse industrial customers in the city, and the entrepreneurial spirit in Aba. So our project is a 140 megawatt project, and as Acha, this is just a fraction of what Acha highlighted as Africa's current demand, which is 135 gigawatts. So this is the first phase of our project, and the Aba IPP combines, it's basically It combines 3 natural gas-fired turbines and over 100 kilometers of distribution lines that are being installed to extend and rehabilitate the current distribution network in Aba. And also, it involves an investment in about 4 substations. The total project cost is $250 million. Now, we have some local support for that. We have a local tranche being provided by Diamond Bank and Stanbic Bank of Nigeria as co-arrangers for the project. In addition to that, we have strong interest from the International Finance Corporation, the European Investment Bank, and Emerging Africa Infrastructure Fund, who have provided mandates to invest in senior and subordinated debt in the project. In addition to that, we plan to make significant impact in the communities that we work in, and this is part of our overall mission to impact and support economic development in the communities that we work in. Because we believe at Geometric that the power problem and addressing the power supply deficit is a fundamental concern and a fundamental problem that needs to be addressed in order to tie into any nation's economic growth and development plans. So that's it. I'm here with my chairman, and we'll be available to address any questions that you may have about our project. Thank you.
We've had 2 ladies come up here and 1 man. It doesn't deliberate. It just happens that these are the sponsors of the various projects that we're working with. The last presentation, I'd like to ask an old friend of mine. We've known each other for 15 years. Friends, never thought that we'd ever be working together as partners. So when I came in and I saw that idea, I said, oh, I know this man. He's a terrific guy. So it was very easy for us to join together to do what he's about to tell you. Okay, please.
Thank you, Isaac. I was going to do like our central bank governor and just rush up here when he was going to begin his speech, but I see I don't have that kind of clout. So I couldn't stop him. Anyway, I'm glad to be up here. Thank you very much. Just a brief overview on Capital Alliance and CAPIC, which is a specific project we're starting our relationship with AFC on. Capital Alliance has been in the business of private equity in our sub-region, West Africa and Nigeria in particular, for about 10 years. At the time when we started Capital Alliance, we believed that the private sector could provide leadership in developing the economy of our region. And in fact, at the time, we had a military government in power, but as it worked out, we've since had democracy coming and the economic reforms take off. Capital Alliance has been effective in working in the private equity space in terms of general private equity, doing things from telecoms to financial services to the energy sector. But we always saw that there were more opportunities to participate, even in real estate, which is another area where there is a sore need for institutional presence in our part of the world. And our model has been to sort of be a catalyst and to work with the private sector entrepreneurs to create not just the capital, but the know-how to enable projects to succeed in our part of the world. When we finally met with AFC sometime this year, especially after Austin Ometoror was appointed as the CEO, just like Isaac said, Austin is also somebody who had worked with Capital Alliance in his previous capacity in Citibank and beyond. So we found that the philosophies and the interests of both organizations were very aligned. And a decision was made by both to begin to explore right away how to work together. And after we had held several meetings and found that there was a lot of complementarity between the project's finance and capital raising and capital structuring functions that AFC will be championing, and Capital Alliance's interest in the private equity niche, if you will, in terms of how the private equity capital comes into projects and works with them from start to fruition and exit, we felt that there was a compelling case for a partnership. And it was against that backdrop that we extended the discussions, and the first plank we're working on is real estate. And CAPIC, which stands for Capital Alliance Private Property Investment Company, basically is the first initiative we're working on. The project, or the fund, the CAPIC is being structured as a fund, which will have a target fund size of $200 to $300 million. Most of that capital is already committed by various institutions, because the institutions that have worked with us in the past continue to be interested. But AFC's position is unique in the sense that they want to work with us not only to invest in the capital of the fund, but also to work downstream into the projects we'll be involved in to make sure that those projects are not only banked, but are banked in time, as the governor, Central Bank governor said, as well as Austin. So we're very delighted about this partnership. We believe that this fund is well positioned to do a first closing by the end of November and to then grow from there. Thank you very much.
Thank you so much, OK. The one thing that OK didn't want me to say is that OK went to Harvard Business School, and he's a Baker Scholar. At the beginning, an opportunity was provided for question and answers. What I'd like to do is to invite Austin to the podium. So if there are any questions, he, as the chief executive, can respond to your questions. Thank you.
Isaac is going to stay with me as well for the questions and answers. Okay, I will be delighted to answer some of your questions. So if you have questions, if you can signify, and we...
Congratulations, this is really an interesting initiative. I just wanted to mention that one of the things that you don't have up there is water, and usually an infrastructure fund will say that they're going to do water and then not do it. So, so I just wanted to just ask you to talk a little bit about water and your thought process on that.
One of the things that's very common in Africa is for people to announce things that they're going to do and not do anything about it. We really have a strong commitment towards water, but we want to do some work. Most of the sources of water in Africa are riverine, and the water comes by way of rain. If you don't use it, you lose it because it flows into the ocean or wherever it goes. In the meantime, the population of the continent has been increasing. The number of waterways has not been increasing. Kenya, for example, a typical example that you see today is Lake Naivasha. You can now walk about 8 kilometers from where the lake bank used to be. How did this happen? Because our people, in an effort to increase their incomes, started growing vegetables and other kinds of things for export. These kinds of things, the economics of this kind of activity requires lots of water. But at no point did anybody stop to think the extraction rate of the water, has it passed the replenishment rate? And obviously it has. That's why the water has been receding. Before we get into water, we want to do some research, the sort of research that Austin mentioned before. So we don't inadvertently make mistake, because there is no substitute for water, and it's very important that when you're doing something with it, you think through very carefully. I happen to know that water makes money because I've been involved in the Lesotho Highlands. It is not because we don't think it doesn't make money, but we think we have to think through it very carefully before we rush into it.
Is there any thinking about bringing in NGOs or nonprofit organizations to partner with you?
Because, as a private sector initiative, we need the capital. And also, I think, one of the interesting things about private sector is that a lot of the issues that the NGOs have, it does make business sense for us to be equally as concerned about the issues. So I think that clearly we want a partnership, and we'll be most delighted to work with the NGOs as well.
Hi, my name is Senator Nkechi Nwogu from Nigerian Senate. I'd like to know, is there a benchmark as to the volume of projects that could come to you for support? Do you have a minimum level? And how do private organizations come to you, what is the lowest project that you can sponsor? Thank you.
The international development finance institutions, the international bank, the local banks. What we're very careful about is that we want to work in partnership with all of the institutions, but at the same time, we want to be careful that if local banks can do what they can do, we shouldn't actually go and compete with them, for what they can do. We've picked critical sectors that we identify as ones that have the greatest development impact and also the greatest return for the investors. We're going to be very flexible as to what represents a minimum threshold or a higher threshold. If you take power, for example, the demands, Nigeria requires probably 40,000 megawatts. We're starting with a 140 megawatt project. But that is because clearly this represents a model for IPP that if it works, can then be scalable and we can have additional capacity. So we're going to be guided, rather than putting a figure as a minimum, we're going to be guided by how critical that project will be in the development objectives and focus that we have.
My name is Tim Turner. I'm the Director of Private Sector Operations at the African Development Bank. I'd like to begin by congratulating the African Finance Corporation. If today's its birthday, well then it's a great honor to be here. On behalf of President Kaberuka, I'd like to congratulate also personally Governor Saludo. It was no coincidence the other day that we were at the African Banker Awards, and it was almost a clean sweep for the Nigerian banks, and I'm sure that in the very near future, AFC will be one of those receiving awards for African Bankers, Development Bankers of the Year. On the pace at which the trajectory at which you're going right now, it won't be long before you're the major player on the continent. I can see that coming. I would also like to say that as you know, Governor Saludo has said, we see ourselves in a partnership with the AFC, and a little bit of competition is not a bad thing at all. In fact, I detected perhaps an African Development Bank implicit in some of the discussion, but indeed, you know, this has brought a new focus to our institution about, you know, what does it take to be relevant in this marketplace? And if it's turnaround time, client responsiveness is a key factor, we'll see, you know, what positive effects that AFC will have on the entire marketplace. Both the African Development Bank, the IFC, the other European DFIs, will all have to respond to setting new benchmarks in terms of performance standards. And I think, you know, this can only be a good thing for African development and for the clients that we serve. So, you know, I'd like to salute you for the work that you're doing. I see on that list of projects, your pipeline, many of those are same institutions that we're looking to work with. And so I hope that we will, you know, we'll work together with you so that we don't duplicate efforts, right? Given the needs of the continent, I think it's really important that we don't find ourselves spending a lot of human resources, processing capacity to duplicate each other's work, and that we should share and learn from each other, like in the commercial banking world where they club, they syndicate, they work together, because they're just, you know, we need to leverage each other's resources, and so we're looking forward to that. And as President Kaberuka said the other day during our meeting, although I was complaining about the fact that you've been poaching my staff relentlessly, no, but President Kaberuka looked at me and said, no, Tim, you've got to take this as a positive thing, right? We're capacity building to an important partner here. Now, if that means we're incapacitated at the same time, you know, well, you know, well, we're going to be going over to see our friends at the IFC, and next thing you know, they'll be incapacitated as we poach their guys, and then they'll be going over to the Asian Development Bank, and so we'll just sort of find it, the level will find itself. No, but in all seriousness, I would like to congratulate you. I think it's a fantastic thing, and we look forward to a long and prosperous relationship together so that we can really do something for African development. This is a fantastic sign. And I think you did a great job, by the way, in picking the 4 stars that you've decided to showcase today, Paulo and Funke and the others, because these are horses that we will be backing as well. I think they're going to be winners in the not very distant future as well. So thank you very much.
I have to mention that we had an excellent meeting yesterday with the president of the African Development Bank and team, and we've agreed on the 3 key pillars of collaboration. Because as I said earlier on, we want to fire on all cylinders. We don't want to reinvent the wheel. There's not much time, because most of these projects take an average of 3 to 4 years before you achieve fiscal completion. So, and it takes probably another year to achieve financial completion. So there's a certain urgency for us to get started immediately, because if you don't, then you're actually pushing the crisis, and aggravating the crisis as well. Thank you very much.
Hello. My name is Kola Gunshulura, AIG. First, I'd like to extend a warm welcome to Austin. I've known Austin for a long time, and I can say I don't think there's a better person that is qualified and suited to run the organization than my good friend Austin. I also want to thank Austin and the governor. I want to say this for making us, should I say, diaspora professionals proud. I walked up to my CEO's office the other day and said, let's talk about Nigeria. And he said, you know what? 10 years ago, I'd have thrown you out my window. But today, I'm willing to listen. And that is a big, big, big change. You've given us the opportunity to talk about a continent we are passionate about, and people are willing to listen now, which was not the case, I can assure you, as we were rising up the corporate ladder 6, 7 years ago. So thank you. I thank you very much. My question is, it seems that based on what I've seen, you are more focused on it seems like a venture capital model. It seems like you are focused on maybe providing equity and maybe mezzanine finance. Are you looking at other institutions to provide the debt in the transaction? Is that your model, or are you more on the debt side? That's my question.
It's the full range of capital that we have to be engaged in, because the challenge that exists is the more you can provide equity capital, the greater the debt capacity you have for the project, and the cheaper the debt as well. So that's why it's so clear to us that risk capital is crucial for the projects. We're also involved in project financing in an advisory and arranging sense, because we want to be able to work in partnership. With the example I gave, usually these projects are significant cost projects, and we have to partner. On average, multi-billion-dollar projects require that we work to make sure that the projects are bankable, and we structure the projects to diffuse as much of the risk as possible so you can attract partners to look at the projects. And I think that role allows us to be more of a catalyst. And of course, what we found out is that the share of African assets in the international debt capital market and international bank syndication market is very minimal. And these same assets are from South America or Asia, having the same economics. In fact, for some of these assets have the same export off-takers. There's no reason why these assets should not be part of the distribution in the capital markets or the international bank syndication market. So we are also equally focused on that, and we want to work, as I said, in partnership with the international private banks.